The Iran ceasefire broke down this week, and oil risk came straight back into the market. Welcome back to this week's market recap. My base case is still that buyers have control, but the rally is leaning heavily on technology while crude and long-term yields keep pushing against it. The mechanism is pretty direct. Higher oil can feed inflation, and the Fed minute showed that some officials are still open to tighter policy if price pressure stays elevated. That combination makes financing more expensive and puts more pressure on companies outside the strongest AI names. So buyers now have to prove that this is more than a narrow technology move. I want to see volatility stay contained and the broader market stop falling behind. A sustained jump in fear while the major indexes stall would challenge the bullish path. The Dow Jones Industrial Average gained about 0.3% on Friday, but it still lost roughly 0.5% for the week. Buyers steadied it late, yet the weekly decline tells us the market was not advancing evenly. The S&P 500 added a little over 0.4 on Friday and finished the week up about 1.25%. That says buyers are still holding the main index despite the oil shock and the renewed pressure from rates. The Nasdaq Composite gained close to 0.3 on Friday and nearly 1.75% for the week. Technology is doing the heavy lifting, so this rally still depends on AI and semiconductor leadership staying firm. The VIX dropped more than 5% on Friday and almost 7% for the week, closing near 15. That is a calm volatility backdrop, and for now it gives equity buyers room to keep pressing. Bitcoin was almost flat in the latest session, but remained up just under 1% for the week. Speculative demand is still present, though it is not giving us the same powerful signal as large technology stocks. The first chart is the VIX, because suppressed volatility is what allowed stocks to absorb the Iran headlines, higher crude, and the hawkish Fed debate. We will check whether that calm can continue, and then use it to judge the broader equity breakout. The latest VIX close at 15.03 sits near the bottom 10% of the last year. This calm volatility zone has held for several sessions, so the market is not treating the renewed Iran fighting and higher oil as an immediate equity shock. The 50 days average near 17.36 remains above the VIX, which keeps intermediate-term volatility pressure contained. The 200 days average near 18.67 is also overhead, so the longer volatility trend still leans lower rather than toward sustained fear. That is a tailwind for equities. It gives breakouts more room to hold and makes an immediate shock reversal less likely, even though the broader index setup still carries rejection risk near resistance. On the shorter-term chart, the VIX is pressing down near 14.99, so the calm is becoming stretched rather than simply fresh. The lower Bollinger Band is the pressure point here. A small volatility rebound would be normal from this area and would not automatically end the equity advance. The warning starts if the VIX lifts back out of that calm zone while stocks stall near their highs. That would strengthen the case for a broader rejection instead of continued trend support. For now, volatility is delaying the bearish equity scenario, not canceling it. Next, we move to SPY and see whether buyers are actually holding the breakout while this calm backdrop remains in place. We looked at the same monthly channel earlier this week, and SPY is still stretched near the top of it. The 30 years monthly log channel has contained roughly 95% of monthly closes, so trading outside it is rare enough to matter. The June 2026 monthly close above the upper rail was the second monthly close in a row outside the channel. The upper rail near 734.32 is still the line I am watching. Holding above it keeps the larger uptrend alive, but buying SPY this far above its normal path is poor risk-reward for me. November 1998 through January 2001 is the important counterexample. SPY stayed around the upper rail for 27 monthly closes before the major reversal arrived, so stretched does not mean immediate failure. RSI is around 72.6, which says the monthly move is already overbought. Let me quickly switch to MACD. Momentum remains positive, but both lines are at record highs for this monthly window, so the trend is strong and late at the same time. Back inside the channel would tell me the extension is starting to fail, and that price may need either a deeper pullback or a long sideways reset. The bullish RSI divergence is already working. Price made a lower low while RSI refused to confirm it, and SPY has rallied about 5.4% over 9 bars since that second pivot. So this is no longer a turn prediction. Buyers have reclaimed momentum, and now they need to keep making higher short-term highs instead of giving that move straight back. The calm VIX and renewed AI buying help that continuation case, but the Iran shock and higher oil leave less room for a weak close near resistance. We have been tracking these same support and resistance lines for a while now. The upper resistance begins in February 2025 and runs across roughly 17 months of repeated tests, so it carries much more weight than a short reaction high. The lower support is newer and rises quickly from the March 2026 low. That younger support, pushing into the older resistance cap, is why the structure still looks like a conservative rising wedge. Let me bring the price action closer. Current price is above both major moving averages and closed near the top of the daily range, so buyers still control the immediate move. The 50 days moving average has held for 9 sessions, which keeps the short-term trend cushion intact. The 200 days moving average remains well below price, so this is not a broken long-term trend. RSI is above 50 and rising, which supports another push before any larger reversal develops. Volume is the weak spot. Prices drifted higher on unusually light participation for 8 sessions, so the advance has less conviction than the closing level suggests. The lower support line is the first failure point. If it gives way, the cleaner downside reference is around 751.35, and rejection risk becomes much more serious. The resistance line is what would invalidate that bearish wedge pressure. A clean hold above it would force me to respect trend continuation instead of expecting a fade. For now, the trend is alive, but the location still favors caution. QQQ comes next because technology leadership is what has to keep this broad market breakout from rolling over. QQQ is still carrying the leadership role, and the key update is that the same upper resistance line remains in place while the lower support has been redrawn at a shallower angle. Current price is holding in the upper half of the structure and closed near the top of the daily range, so buyers still control the immediate move. The 50 days moving average sits right under price and acted as support. As long as QQQ stays above that line, I still favor another push higher. The 200 days moving average remains well below as the broader trend floor, so this is not a damaged long-term trend. RSI is back around 50 and turning up, which tells me downside momentum is no longer confirming a breakdown. Volume is the weak spot. The advances drifted higher on unusually light participation for 5 sessions, so the price strength is better than the conviction behind it. The support line is the first place buyers have to defend if AI leadership is going to keep carrying the broader market. The resistance line is the upside test. A clean break through this area would put the next resistance near 756.58 in play and would weaken the broader rejection risk. A clean loss back below the 50 days would flip that quickly. The convix helps technology for now, but higher oil and a more hawkish Fed still make weak participation dangerous near resistance. So QQQ keeps the bullish side alive, but it is still a concentrated move. IWM comes next because small caps tell us whether that strength is spreading or staying trapped in the largest growth names. Small caps are giving a much weaker answer than QQQ. The bearish RSI divergence is already playing out. Price made a higher high, RSI failed to confirm it, and IWM has since fallen about 4% over 6 bars while making lower short-term lows. That moves this beyond an early warning. Sellers have control of the short-term move, and buyers now need to reclaim the lost momentum instead of relying on the larger uptrend. The COMVIX is stopping this from turning into a broad panic, but higher oil and a more hawkish rate backdrop hit smaller, rate-sensitive companies harder than the biggest AI leaders. For me, that weakness supports the cautious broad market view. The headline indexes can keep rising, but the rally remains vulnerable while small caps are moving the other way. The bearish MACD divergence confirms the same loss of momentum, with price making the higher high while MACD made a lower high. Bulls need MACD to stabilize and price to reclaim the breakdown area. Until then, downside follow-through has the edge, and rising oil is the next pressure point to watch. The Iran ceasefire broke down. Tanker security around the Strait of Hormuz stayed unresolved, and crude rebuilt a geopolitical premium. WTI finished the week near $71, up about 4%, but that rebound is still coming from a badly damaged trend. The primary Elliott count tracks the larger fall from roughly 119 in March to the early July low near 67 as the first major leg down. Elliott wave simply counts the major turns in price. In a bearish count, the numbers help separate the larger decline from the smaller rebounds inside it. The wave 1 low near 67 is the reaction point now. After a drop this large, I would expect crude to attempt a normal counter-trend bounce before assuming the next major leg lower has begun. Put simply, the war premium is helping that bounce, but it has not repaired the larger bearish structure. The alternate Elliott count still respects downside continuation, while crude remains below the broken trend area, so I would not treat every geopolitical spike as a new bull market. The latest swing structure still shows a lower high and a lower low. That keeps the larger trend pointed down even as short-term momentum tries to recover. The Elliott invalidation level remains the original high near 119. Crude does not need to reach that level to improve, but the full bearish count is not broken unless price eventually reclaims it. For equities, this complicates the rally rather than ending it immediately. A contained oil rebound can be absorbed, but another sustained surge would add inflation pressure and make the next yield chapter much more important. The rebound in oil and the hawkish split inside the Fed minutes both pushed the inflation problem back toward the bond market. The 10-year yield finished near 4.56%, so rates confirmed the pressure story instead of giving the equity rally an easy escape. Current price is near the upper end of the structure and closed around the top 5% of the daily range. Yield buyers controlled the finish, and this still looks more like continuation than rejection. The 50 days moving average has held for 6 sessions and sits underneath the move as the first support area. The 200 days moving average is also rising below price, so the longer trend in yields remains intact. RSI is above 50 and rising, which keeps short-term momentum pointed toward higher yields. MACD is also turning up, and that adds another reason not to dismiss this as a brief headline spike. The MACD histogram has stayed positive and expanded for 4 sessions. Momentum is accelerating in the bullish direction for yields. The resistance line is the immediate test. If TNX holds above this area, rate pressure can continue higher and make stretched equity valuations harder to defend. The support line is what would weaken that call. A fallback under the breakout area would turn this into a failed push and give growth stocks more room to breathe. For now, higher yields reinforce the rejection risk hanging over the broad market. Nvidia comes next because semiconductor strength is the main reason technology has been able to push through this rate pressure. Nvidia pushed through a noisy week for the chip trade. The company rejected reports that its future Kyber platform faced a major delay, while analysts continued to argue that AI infrastructure spending could outweigh pressure from custom chips. Bank of America also framed the stock as undervalued ahead of the next product cycle. Even Meta, moving deeper into its own silicon, did not stop buyers from returning to Nvidia. These support and resistance lines have been redrawn since the last chapter, so I am treating the current structure as a fresh test rather than the same setup rolling forward. Current price broke higher from an inside day and moved back toward a resistance line that has capped the stock for roughly 39 sessions. That gives buyers short-term control, but the breakout still needs follow-through. The 50 days moving average sits directly under price and acted as support. Holding that line keeps the rebound alive and makes continuation more likely than an immediate rejection. The 200 days moving average remains lower as the broader trend floor, so the longer AI uptrend has not failed. The resistance line is the real test now. A sustained move through it would turn this from another repair rally into stronger leadership again. RSI has reclaimed 50, which tells me momentum has shifted back toward buyers instead of merely becoming less bearish. MACD is also improving, and that strengthens the case that the rebound still has room to run. The MACD histogram has been positive and expanding for 3 sessions. Upside momentum is accelerating rather than fading at resistance. Volume is the caution flag. The 5-day average sits in the bottom 20% of this chart window, so participation remains unusually light for a leadership breakout. I still favor continuation while Nvidia holds above the 50 days and presses through resistance, but weak volume leaves room for another failed push. Microsoft comes next because cloud spending has to support the same AI demand story from the customer side. Microsoft announced roughly 4,800 job cuts this week as it reshaped sales and Xbox operations while continuing to prioritize AI investment. Investors are now looking toward the July 29th earnings report for proof that Azure growth and AI demand can justify that spending. New British oversight of major cloud providers also added a regulatory issue for Microsoft. So the company story still supports long-term AI confidence, but the stock has not repaired its trend yet. Current price remains below both major moving averages and is testing a descending resistance area rather than clearing it. For now, rejection still looks more likely than a clean breakout. The 50 days moving average remains above price, so the short-term trend is still working against buyers. The 200 days moving average is also overhead, which keeps the broader trend defensive despite confidence in the cloud and AI business. The resistance line has capped the recovery for roughly 26 sessions. A clean close above it would be the first move strong enough to change the bearish setup. RSI is near 50, so momentum is balanced. Buyers are no longer deeply oversold, but they have not taken control either. Volume is the weak spot. Price has drifted higher on unusually light participation for 6 sessions, so this rebound carries less conviction than the price move suggests. Until Microsoft clears resistance and recovers the moving averages, I would expect another rejection toward the middle or lower part of the structure. That weakness reinforces the warning that this rally still depends on a narrow group of stronger AI leaders. The economic calendar comes next, because inflation data and the Fed outlook can decide whether those expensive growth leaders keep getting support or finally lose momentum. Let us have a look at the calendar for next week. This is where the rally runs into a real inflation test, and I think Tuesday carries most of the risk. Tuesday, July 14th brings headline and core CPI, followed by Fed Chair Warsh testifying. Cooler inflation would take pressure off yields and give technology buyers more room, but another hot core number would strengthen the case for tighter policy and make the breakout harder to hold. Warsh matters because traders are already debating whether the next Fed move could be a hike. A firm inflation-first message would probably keep yields and the dollar elevated. Wednesday, July 15th follows with core producer prices and another round of Warsh testimony. Sticky business costs would reinforce the inflation warning, while softer producer pressure would help calm the bond market. Thursday, July 6th shifts to retail sales and the control group. Steady spending without another inflation scare helps earnings confidence, but very strong demand could keep the Fed cautious, while outright weakness would raise growth concerns. Friday, July 17th brings Michigan consumer sentiment, A modest improvement helps the soft landing story, but traders will also care about whether households still expect high inflation. So the balanced path is simple. Cooler inflation with stable consumer demand gives buyers room, while sticky prices, hawkish Fed language, or weak spending keeps rejection risk alive. My personal read is more direct. I think this calendar is more likely to hurt the rally than help it, because inflation and yields already have the market stretched at the wrong moment. I still give the downside warning the edge, even after a strong week for the headline indexes. The rising wedge carries roughly 77% downside break odds, and that keeps every rally vulnerable until price proves it can hold above resistance. The key resistance zone near 756.7 is the first line in the sand. Buyers have to absorb that area, not just poke above it intraday. Again, I do not need a dramatic sell-off on the first rejection. I need sellers to keep control and carry the pressure into the close. RSI at 59.1 is still below an extreme level, so momentum has room to push before the chart becomes fully overbought. The upper Bollinger area is already being tested, and that tells me price is stretched enough that chasing strength here is poor risk-reward. Stochastics are also running hot, while MACD remains above zero. So short-term strength is real, but the location is still dangerous. The COM VIX is the strongest argument against an immediate shock reversal. It gives buyers room, but it does not erase the wedge risk. Again, the whole question is whether buyers can reclaim 756.7 cleanly, or whether this becomes another rejection from the same overhead area. Higher oil, firm yields, and the hawkish Fed debate do not replace that level. They simply make a failed reclaim more dangerous. Let me quickly shift the chart into the future so we can look at how price could develop from here. The path I am tracking first is a rejection below resistance, followed by pressure toward the nearest support shelf. The first support cluster sits around 742.9 to 743. That is where I would expect the first serious reaction if sellers take control. Again, if price reaches that area and buyers reclaim it quickly, the market can still reset without turning into a larger breakdown. But if 743 gives way and stays lost into the close, the downside move starts looking much more deliberate. The second support cluster is near 729, with the broader reaction area running roughly from 727.3 to 730.8. That lower shelf is where the wedge breakdown would become much harder to dismiss as a normal pullback. The larger downside path starts opening up if both support zones fail and sellers keep control after each test. The unfinished gap around 659.6 to 671.5 would then become part of the longer repair risk, not an immediate one-step target. Now the upside alternative is straightforward. Buyers have to reclaim 756.7 and hold it, because that would invalidate the active downside setup. If that reclaim sticks, the broader uptrend stays alive and the next major test shifts higher. The upper resistance area near 771 is the next overhead decision zone. That is where I would expect another serious fight between momentum buyers and sellers. Do we get the clean reclaim and continuation, or do we reject first and test support? That is the trade-off I am watching. For now, I am not chasing. Below 756.7, rejection risk still has the edge. Above it on a firm close, I would respect the upside again. That is the setup for next week. Stay patient around resistance, respect the inflation risk, and let price confirm the next move. Thanks for watching, and I will see you in the next market recap.